Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Well, if there is aggregate demand, when the economy is expanding, aggregate demand increases, interest rate go up, you have higher GDP growth rate and higher profitability. That's bullish for the market. So we see that happening. We like to increase exposure to the US, large cap stocks. Now, if the dollar declines, say, well, we might still like large stocks, but we might not want to be in the US. So we play those things around and we move our funds around because there is always somebody doing well and there's always somebody doing below average and there's always somebody above average. So we always want to be in the above average side and fully invested, and then we let Donn take care of the tail risk.
Hello, everybody. Welcome back to The Derivative. You ever heard the one about the professor, the prop trader, and the risk manager walking into the bar? Me neither. So we got all three of them on the pod today to hear the story. It's a story about blending beta and alpha. It's a story about convexity and rebouncing. It's a story about global macro. It's the story of Victor Canto, Jim Kleinops, and Donn Stobierski. Did I say that right, Donn?
Stobierski. It's close.
Stobierski, sorry. Who've all been involved in trading markets nearly 100 years combined. So welcome, guys.
Thank you.
So I've known Jim and Donn for a while here, although haven't seen your familiar faces since the pandemic began.
Nope.
You'll notice I'm rocking the second version of the COVID cut, which has become a new family activity of shaving Dad's head. And Victor, great to meet you finally. We've conversed over email. I've seen all your research and whatnot over the years, so good to meet you. We usually start out with some personal backgrounds, getting to know you, but we have a lot to cover today and all three of you, so let's just do some quick intros to start us out.
Okay.
Jim and Donn, you're both founders and managing members at Black Bear Capital Advisors, which manages your personal assets. So Jim, why don't we start with you? You worked at companies across the board, UBS, Deutsche Bank. Give us a quick rundown.
All of us go back 40 years from starting with Victor and Clay Struve, our other partner, hanging out with Fisher Black at MIT. Tong Wei and I crossed paths at O'Connor and Associates. We spent many years where it went from O'Connor to Swiss Bank to SBC Warburg to UBS Warburg to UBS Payne Weber, and then I left. I then first met up with Victor in about 2002. We were working on what was called the Explorer Fund, which is kind of a precursor to what we're doing now. We've all worked on similar systems, look at risk, as Donn will go into the kind of the whole SIBO, the option business is all, we all trace back to the early days.
And give us a quick little rundown of the O'Connor tree, right? Because I feel like there's, kind of like the tiger cubs. Like the number of great traders who've come out of that tree is unbelievable.
There's, at one point we're head of O'Connor alumni. We're heading derivatives at Deutsche, Morgan Stanley, UBS, Bankers Trust, all and Morgan Stanley, all at the same time.
And what was when they were back in the pits? They were just one of the first to have basically sheets with their own own Greeks.
We had theoreticals, but I call Clay Struve the inventor of risk control, and we were built about trading options as a portfolio and looking
and managing the risk as a firm.
Managing the overall exposure of the firm in as near as real time as you could.
So these like the early days of delta hedging and things of that.
Yeah, we had mainframe computers and dumb terminals and clerks tallying, but we knew kind of our what our positions were, which worked great until 1987, when all of a sudden 12% up and down slide wasn't enough. But we all kind of started with that. We've always been trained to look at the both the down and the upside, but I think our focus was, what was interesting is no matter what model you're using or what are the conditions that will make it break, and protecting against it. So we've been I'm
going to write that book one day when I have some spare time. I think that'd be an interesting book of tracing the lineage and the background of that whole thing.
The trees, yeah. But and Donn was right with us, because I will let him go into his background, but we all crossed paths, and Tongwei, our other partner, we've built 3 different systems, including our core systems for trading machines, which we ran for a few years. So we've been doing the same thing, and the kind of the genesis of this is.
Well, let me cut you off and go back to Donn. We'll come back in a minute. So Donn, you have 2 of the bigger trading firm names in Chicago on your resume, Hull and Citadel. Give us a quick background.
Sure. I started just a few years after Jim on the floor of the CBOE with Hull Trading, traded in various equity option pits, ran the DPM, but then they were also sort of pioneers in electronic trading. But at the time, this is in the late 90s, all of that was overseas, primarily Germany and Switzerland and a few other places. So I had the opportunity to move there to Frankfurt, Germany, and help get that business going. Then about a year or so after I was there, Goldman Sachs purchased Hull Trading, and I was able to move to London for about a year and a half and help integrate that business.
And Hull famously, I think we did a blog post, wasn't he one of the only buyers in '87? Like, he has the trade card where he bought all the
he does. He was the only buyer. There was no markets open except for I believe it was the
MMI.
major market, MMI index. Yeah. And someone just said, hey, I need a bid for 100 or 200, which was an enormous size. I don't even know if they were solvent, to be honest, but no one did. So he basically bought the bottom in 1987 and about sold the top in 1999 when he sold the firm to Gold.
All right, well, hook us up with him on a podcast down the road here. But sorry, sure. So then you're in London?
Yeah, no, then so we were there integrating the business, and then after my time was up, I was able to move back to the U.S. and I was promoted to the desk head for the index trading. But then a couple years after that, I had the opportunity to move to Citadel and help get their option market making business going. And as you know, after a few years, we were the largest option market maker in the country. And I'd say a couple of years after that, I became the managing director and desk head in charge of portfolio and risk management.
Do you wish that Robinhood was around back then, where you could be buying that order flow?
Well, I think they are. I don't know for sure, but that's very profitable order flow, and that was part of the name of the game. But yeah, and then just a couple of years ago, became one of the founding members of Black Bear Capital Advisors. So here we are.
Love it. And now, Victor, you're the chief economist at Cadhina Co. Did I say that correctly?
Cadhina and Company, yes.
Cadhina and Company. You're also an author, economist, PhD, bunch of stuff, contributing research and whatnot to institutions around the world. So we'll let you go a little longer if you'd like to, but give us the background.
Well, it all began in the sugarcane fields of Dominican Republic. How's that?
Okay.
I'm just kidding.
No, I like that. Is that your accent? You're from Dominican Republic, Richard?
I am. I'm from the town where all the baseball players come from.
Okay.
I'm going to mention one of them, but I guess...
Roberto Clemente?
No, he's persona non grata in Chicago now.
Okay.
Sammy
Sosa?
Yes.
I guess we we're back to liking him a little bit, but yeah.
Okay. I went to prep school in the East Coast, went to MIT, got a degree in civil engineering, went to University of Chicago, got my PhD in economics, and I moved on. At Chicago, I met Fisher Black. That's how I ended up meeting Clay later on, a few years later.
Fisher Black's of the famous or infamous, depending on your stand, Black-Scholes model?
Yes, he was. And Myron was ahead of me, a couple of years ahead of me. But then I went to USC. I taught for 10 years at USC. I was a tenured professor there. And I had a little company. I had a partner. We had a company for about 30 years or so called Victor Canto and Associates. And we parted company about 20 years ago. I've been doing investment advice and money management since then with R2. We had a few. So I'm very interested in politics, economics, and investments. So I try to combine all of them into one shop, and that's what I try to do nowadays.
And so you do that mostly through this company, but you're also involved with La Jolla Economics?
No, I do different things. I sell investment research to institutional investors. And I help a lot of people with their strategies and their investment, try to make them more efficient investors and how to incorporate some of the macroeconomic effects into their portfolio strategy. I do that as a consultant, but I also get involved in money management with other people. I have a couple of interest in different money management, small money management companies. And my biggest one, I was very involved with the Lazard Asset Management. They use a lot of my strategy in the Lazard Capital Allocators series.
And so what do you think of yourself first, as an economist, a professor?
Oh, no, a good husband.
A good husband. All right.
Yes.
That's a great answer.
Yes.
Write that down. I want that.
Yeah, I'm going to have to, if my wife ever listens to one of these podcasts, I'll make sure I say that.
No, but I'll tell you, I'm very fortunate now, seriously, in a serious base. I was very fortunate at the time I went to the University of Chicago. They could have never been a better place in the world. And Chicago gave me a great opportunity because I had never taken a class in economics. And I went, and they accepted me when I couldn't get into anywhere else. And at that time, Chicago was the #1 place in the world. And that was at the time that Jim Fama was doing the efficient market, hypothesis, and all that. And you had in the economics department, the rational expectation. Then you had in the political scene, the Chicago boys in Chile. So you had the connection of politics, finance, applied economics. So I was very fortunate to experience all that. At the time when they were still intuitive, they have become very mathematical. But I did learn, how to try to integrate finance, economics in a practical way and apply it to the real world.
That's the best, because that's the knock on economists generally, right? They can't apply it to the real world. So you've done a good job of that, and your research, quote unquote, is also doing practical allocation percentages to different assets. Yes. How does that work? That's across the globe or domestically?
Across the globe. I hate to sound like a Chicago person. But,
no, hey, we're all Chicago people here. Go ahead.
They think they know everything, right?
We do.
So then you'll do anything. No, I'm just joking. I'm a citizen of the world, and I believe in global investing. And when you you look for return, you look for the best risk reward anywhere in the world. I have two very important words that guide my investment principle: liquidity and transparency. They're really important to me.
Okay, I love that.
I want to be able to get out, and I want to know what I'm buying and selling.
Right. So you're shying away from frontier markets and whatnot?
No, they're okay because they're liquid market. They're relatively liquid market in an ETF world.
So let's jump back to Jim or Don and talk about how you guys hooked up with Victor and how you started managing your own money with a kind of a unique investment strategy. Who wants to jump on that grenade?
Don, you have a crack at it.
Okay, well, I mean, this is sort of, when Jim and I, met through TW, who again isn't on right now, we talked about, tail risk strategies. What's the, and that's a hot topic now, obviously. So, a few years ago, well, TW and I were in the same firm, and we both left, and sort of looking for the next thing to do. But TW for a long time had been working on tail risk strategies, and I was saying that's kind of a hot topic right now. We could dig into more later, but there is certainly a lot of interest in it. And what's really the best way to mitigate downside risk? Is it, the simple answer is just to sell what you have or buy puts, but the trick with these is to find a very cost efficient way to protect your downside, because us, like a lot of other people, we're not looking to hit home runs at this point in our career. We want to preserve our assets and make some return as the market goes up, but we don't want to get destroyed if the market drops 20, 30, 40%, as we've seen, a few times in the past couple of decades. Well, we just saw it in March. So that we were working on and thinking, well, this really fits what we want to do. But what about other people? There may be interest in this. So, we started experimenting and working on that strategy, but really the best thing to do is to combine that with a beta strategy. So if you have your beta and your tail risk strategy integrated into one strategy, where you can work them together, that's the best of both worlds.
So let me pause you for a minute. So let's just talk about TW for a second, of who that is and how he fit in.
Oh, Tongwei Co, as I said, he worked with us at, it was SBC O'Connor back in the 90s. And he ended up running electronic trading for all electronic vol trading for UBS globally, out of London and then Stanford. When the decimalization of options came about, they realized they had to rewrite all the risk systems at UBS, and so him and a couple other colleagues left UBS, and we started this company called Trading Machines, which was just to do high frequency market making. I was like the two founders and myself. I was brought on as risk manager, and we built a automated trading system. And then we had the whole issue with the after the flash crash. It became very difficult times for not only stock market making but options. And so I returned back to Chicago, and Tongwei moved to Chicago and worked with our other partner, Clay Struve, at CSS for several years before going to Volant. But we always remained in contact, and having run through 1997 together and 2008, we've seen a lot of crash events. And
so you two were both looking personally with your own money for some downside protection. TW had a strategy. So
well, we the first thing was we kind of know what the strategy is. The hardest part was, how do you get what is your true beta? And the more we looked at it, we said, hey, we're gonna I got back in touch with Victor, because he's been running this model, and I said, this is about the purest. At least with Victor's model, we'll know exactly what we're betting on and why, right, and what are the drivers. And
let me come back to the beta part, because I want to focus on the tail part first. So can we dig into how the tail works?
The tail works. We looked at this
without giving away the secret sauce.
No, not the secret sauce, but if you're running a global equity macro as we are, and you say, okay, I know how much S&P or mid or small cap I have, what do I do? if I go full out and try and hedge with puts or synthetic puts on any one of those, I am impacting my delta, my asset allocation. And pretty soon we would be running an index option book, not an asset allocation. So we look at the proper sizing. We know what our beta is, and the closest I'll get to secret sauce is we do have a proprietary models for VIX and VIX options and S&P. It's all integrated, and that helps us size the appropriate amount of protection. And I think Donn touched on it. One of the critical issues is what is your, what are your pain points? And we focus protecting against 10% or greater drawdowns, not every 5%. That's
right. So you can give up. You can give up some of the belly to be out on the wings, and then that's less costly.
Well, yeah, and it's one thing to trade options and another thing to use them. And we think we have an efficient way. We certainly know exactly what our beta is, and we know our tolerance level. As I say, you're targeting 10% out of the money, but we're or 10% or greater drawdowns. That does not mean, we buy a 10% 1 year out of the money put and hold it. That does not work.
No, your goal is to beat that cost. We
want to be as efficient as possible, and we think our combination of index options and VIX options and futures, it gives us a very cost-effective hedge, and that's all we're worried about is protecting the downside.
Go ahead, Don.
You need to be careful with the derivative instruments that you use. They need to be appropriate. It's important to understand the characteristics of these and the different dynamics, so you're not overpaying something you don't need, and that's what our quantitative model is for. And in terms of integrating the tail risk into your portfolio, one of the most important aspects is to capture your gains when there are gains with that tail risk strategy. So, the market's really dropping again. If it's not 2 or 3, but 10, 15, 20%, you're going to get gains there. What do you do with those? How do you reinvest them? Because these reinvested gains can compound your returns over time, which is obviously what you want. That's critical for long-term performance.
So how do you view that though against the possibility of it goes down 60% and you got out at down 20%?
We don't get out. We always maintain a certain convexity risk profile. So we're able to do this, again, there's a little of the secret sauce there, but we're able to do this as the market drops. There'll be a point where you start getting outsized gains in your convexity. So, you not only get some mitigation against your beta, you get a lot. Well, at that point, maybe you can take some of those gains. Yeah. So, but it needs to be a part of your portfolio in order to be able to do that.
And then the flip side of that is, what do you do in a end of March, early April scenario where the protection is super expensive, either in the options or the VIX is at 80, right? And even the far out VIX was at 30, 40, 50.
It was crazy. There's different things you can do.
It's smart to wait and buy 60 calls in end of March.
Say it again.
It was not a good. It's kind of like trying to buy insurance after the house is on fire. As Don says, we always maintain the convexity, and if I don't want to get technical, but if you think of a very large back spread, as the thing moves, you have to take some off. Then with futures, we just hedge what we call our volatility exposure, and realize profits on the way up, and maintain, we always keep our hedge on. Just the sizing will differ, and the term that we
but in theory, mathematically, you either have to go smaller size or further out, or you have to give up some, kind of have to accept some basis risk there too.
Sure, there's going to be some. I mean, you're not going to have it both ways without paying some sort of cost. But, the idea is, for us to capture a decent percentage of the upside, and we'll get a little help from that with Victor's model, even be better than just, the SPOOs or just some other flat beta product. But, our biggest concern is protecting on that downside and mitigating that risk.
Can I say something here?
Yes.
I'm a simple man. So let's use some trivial stuff like capital asset pricing model. Where we learn, the capital asset pricing model taught us about risk. For example, there's some diversifiable risk and there is not worth paying for any risk that you can diversify. And the argument is, if you have two assets, let's say two assets that move in opposite direction, and when one goes up, the other goes down, all you need to do is do what? Size them correctly. And if you're able to size them correctly, you can eliminate all the volatility and you have a positive rate of return guarantee with no risk. That will be the ideal. Now, let me tell you a bit, this is how I look at the world, where we have the two assets, one is beta and the other one is convexity. But you have to look at them jointly in order to be able to size them correctly and to manage it. Because if you hire two independent managers and try to combine them, what happens? If you don't size them correctly, then you're introducing what? A risk that you could have avoided and diversified that you didn't. And you are adding exposure to so the moral of the story here is, yes, you can hire, like a convexity manager to manage your beta separate, and it will protect you and it will do a reasonable job. But if you combine both of them at the same time, you can always size your convexity properly. And in some cases, in the case you're talking about, you might not need to buy as much insurance because of your beta is protecting you on some of the other issues. Mm-hmm. You see what I'm saying? And that's very important insight that a lot of people don't think. And I think this is what what we try to do. We combine both of them and look at it, holistically, however you want to call it, at one point in time. So you're always, you don't look at convexity alone. You don't look at beta alone. You have to look at both of them at the same time, because otherwise you're missing some diversifiable risk and you'll be paying for insurance that you don't need to pay for.
Right. So let's dig into the beta side of that a little bit now. So how are you said you're a global citizen, you're looking at the global markets. Let's talk about which markets that entails and how you approach the beta side.
Basically, as I told you, remember my two famous words were liquidity and transparency. So the argument is, to us, the world is defined by our liquid assets. So if you look at the market capitalization of all liquid assets, that tells you what the benchmark should be. And then the question is, do you think an asset class will outperform or underperform? And then if you think the asset class will outperform, you increase your exposure to that asset class. If you think it's going to underperform, you reduce your exposure. And that's what we try to do in a very systematic way, that we have an econometric model that tries to measure that. We also make a very important assumption here is that we think that it's costly to adjust. For example, we have the coronavirus now. People say close down. It will take a while to get, you don't get back to normal overnight. It will take 6, 7, 8 months, a year. So if you know that it's going to take a while, why rush it? We know where we're going. We'll take advantage of that, and we'll ride that wave. We don't have to capture everything. We're not saying that we're going to be the best. We just want to be above average.
And let's talk which assets. So equities, obviously.
Yes. Anything that's in the MSCI, how's that? In the Morgan Stanley Capital Index. Anything in the MSCI is fair game.
So just for the listeners, roll off 10 or so assets that are in there.
Oh, well, we have in the US, you have large cap, mid cap, small cap. Then you can have Europe, you have Asia, you have the emerging market, frontier market, you have the Pacific market, and then you can break it down by region if you want to.
Okay, but we're talking all equities.
Yes, all equities.
So the model doesn't consider, okay, bonds are yielding 12%, as if that'll ever happen again in our lives, but if that was a thing, would the model say, hey, we should be in bonds instead of equity?
Well, yeah, but you see, if you look at that, then and then I have to answer my question a little bit differently. Is if you're doing a global balance, so to speak, asset allocation, the bonds will be like the hedge of your portfolio.
Yeah, they'd be the convexity piece.
And they did do that. If you look at the TLT, just to pick a number, the TLT has done like 20% for the years. But imagine if your money man, all you had to do was buy TLT at the beginning of the year, and you'll be okay. Yeah. But almost as good as Jim.
Almost.
But the point is that we think that the fixed income is would be like a poor man's tail risk.
Okay. And so the beta component is just equity beta.
Yes.
Got it. And then so digging into that, like Europe has underperformed massively for years and years now, right?
Not since the recovery. If you look at it's sort of interesting that you mentioned that. If you look at this stuff, I'll tell you, like, it's sort of like a correlation, but it really, I'll bring it back to why it makes sense. If you look at the coronavirus, whenever, early on, the Europeans were doing much more poorly than the US, and the dollar went through the roof. Then they sort of got it under control with the lockdown and the flare up here. And then we got worse than that. And since then, the dollar has been weakening. And guess what happened since the dollar started weakening? The European market and the foreign market have been doing a little bit better than the US market. Mm-hmm. So, and that identifies one of the variables that we pay attention to, the foreign exchange value of the dollar. When the dollar is appreciated, we tend to increase our exposure to US equities. When the dollar depreciates, we like to be away from the US.
And is it purely a systematic model? Are there discretionary overlays?
No, it's systematic. It's a strictly quantitative. We have an econometric model that uses historical relationship and try to estimate the expected rates of return and standard deviation. And once we get those estimates, we use the traditional finance capital asset price model optimization technique, but with our expected return and our standard deviations. And we estimate the probability that one asset class will outperform. Instead, you see, when you do an asset allocation, like everybody talks about, it gets very complicated because people don't understand that. What we've done is we simplify it pairwise. We said, is the large cap going to outperform the benchmark? Yes or no? Yes. And we, based on the expected return, what is the probability? We say, well, it's 60%. Mm-hmm. Just to pick an example. So if you flip a coin, it's 50-50 head. So if it's 60, you say, oh, it's better than 50-50. 70 is much better than 50-50. 80 is even better. So then essentially what we're saying is the probability tells us how many chips we put on the table.
Okay.
The bigger the probability, the more chips you put on. And then the initial bet is also depends on the size of the market, on the market cap. Obviously, you'll put much more money in the US than you'll put in Dominican Republic.
Yeah.
Because one doesn't move the needle and the other does. So, so we take our model, incorporate the size of the economy of the market and the likelihood of outperforming.
So you're typically always overweight US just based on that mere factor alone.
We have been over the last few years, but in general, I think if the dollar the cycle is starting to turn, I think over the next few years, you're going to be much more international then.
Let's just get all your thoughts on this isn't necessarily apropos to your model and everything, but just on the dollar and the US economy and Apple and, 5 stocks are really are responsible for all of the move.
Well, there is a misnomer. I hate to.
Please, no, correct me. I
found
stuff out that may or may not be true.
What you said is exactly true.
Oh, good.
In the following sense, you are true, actually, but that's not necessarily true in the following sense. Do you realize that there are 245 stocks that have positive returns year to date?
245?
In the S&P 500.
Wow, okay.
Okay, so that tells you there are plenty of sea in the fish.
Yeah.
You don't have to fish those 5 stocks alone. So remember, we don't have to be the best. We just have to be good. And we're better off looking for the other 240 because nobody's paying attention to them. Everybody's paying attention to the FANGs. Nobody's paying attention to the other 240, and there is a high rate of return in those 240 stocks.
But your model doesn't buy individual names, right?
We could. No, we haven't done that. But we've done no. The model, since we have the probability and it's cap weighted, one of the good things our model has is that it works either bottoms up or top down. If you forecast each individual stock in the S&P 500 and you add them up cap weighted, it adds up to the S&P 500 forecast. So we can slice and dice going downstream or upstream, whatever the client desires will do.
And just for you personally, does this current environment drive you crazy with like Tesla and all these things disconnecting from reality?
No, it's wonderful.
Good.
Yes, because there is volatility. You can make money on volatility. And then, if you identify the underlying trend, the people who are high frequency traders tend to ignore the systematic underlying trend that we're paying attention to. And that's what the model tries to capture. So
I saw the average hold time of Tesla is 11 days.
Yeah.
That sounds high.
Yeah.
But, we remember, like what Don said, we try to be fully invested in almost everything. What we change is the weighting, the allocation changes over time. So we're always fully invested because you're fully invested, you watch it all the time. What you do is you buy more or you buy less. You adjust your weightings of each one because what we're trying to do is beat the global benchmark by a little bit. We're not trying to hit a home run.
Which the global benchmark here is the MSCI All World.
Yeah. MSCI All World.
So
all you want to do is, I joke around, like I tell people, my dream performance is I just want to beat the market by 1 basis point every single day.
Yeah, that'd be great.
Yes. That's all I want.
Especially when the market's ripping off 30% years.
With no volatility either,
But so let me bring you back. So you're saying you want to be fully invested, but then you also downsize. So in my brain, that means I'm not actually fully invested. So if I have
No. I am fully invested. What I'm saying is, for example, how do you adjust our risk and all that? For let's say right now, let's say I'm large cap.
Yeah, let's say I have $100 invested. All hundreds always invested?
Yeah, all $100 invested. And I'll have, let's say, like 60% on the US large cap on the S&P 500 and 40% all over the world. What I might change is, if I see the world changing, I might reduce my exposure to the US and increase my exposure. For example, like we're looking at November, we have an election coming up. And what are the scenarios and what are the variables? Let me tell you, we pay attention to 4 variables. Interest rate, for the sake of argument. Like we say, okay, inflation. So what do? If you think the inflation rate is going to go up, you shorten duration. Why? Because, although we don't invest because long-term bonds are going to get hammered and short-term bonds do not. So you should reduce duration. Okay, fine. Then the other one, if you see interest rate going up and there is no inflation, what do you say? So, well, if there is aggregate demand, when the economy is expanding, aggregate demand increases, interest rate go up, you have higher GDP growth rate and higher profitability. That's bullish for the market. So we see that happening. We like to increase exposure to the US, large cap stocks. Now, if the dollar declines, say, well, we might still like large stocks, but we might not want to be in the US. So we play those things around and we move our funds around because there is always somebody doing well and there's always somebody doing below average and there's always somebody above average. So we always want to be in the above average side and fully invested, and then we let Don take care of the tail risk.
Yeah. And so, but from the tail risk perspective, you guys were saying, depending on how much exposure there is, you can keep the tail risk, but it seems like there's always 100% exposure.
Yeah, no, yes, but the question is, we look at the relative to the benchmark, let's say for the sake of argument, the benchmark allocation to the US is 50% and we're at 60. So what is our risk? Say, okay, what happens to the US situation? There are 4 possibilities. The US volatility can go up, the expected return can go up. If you look at the risk return, there are 4 different core quadrants that you could be in, that you're protected. But there's one quadrant where you don't really care. What do I care if the market surprises me and the volatility and rate of return go up? Am I gonna be unhappy? So for that possibility, I don't buy insurance as much.
Right,
The one where I want to buy a lot of insurance is if I think the market is going down, the volatility is going to increase.
But Don, are you trying to, for your money, protect 1-to-1 a sell-off, or something less than that?
Not necessarily. I mean, we look at our quantitative model, and that really helps us sort of combine all the instruments that we're trading, and helps us get the most efficient hedge on when for the portfolio.
And then if it's at 50-50 US foreign, are you only hedging the 50%?
I mean, we're going to target it appropriately. So yeah, if it's going to be, somewhat less than that, then we'll adjust our hedge accordingly. So again, we want to keep that cost as low as possible.
Right, but you're not only hedging the US percent, like it's the total portfolio. Yeah.
Correct.
And then why go with this model over just holding S&Ps or having a simple, SPY ETF?
Well, I mean, this model is far superior than just spiders. I mean, there's going to be times, like Victor probably answered it best. There's times when it's the best to be in the US, but there's going to be other times where you want to be a lot more international. Like one thing I like about this, one problem I always had was, how do I invest my beta assets? Do I go all S&P? Do I go IWM? Do I look at the world market? Do I talk to my financial planner and say it's 50% this and 30% and 10% this with no reason? Now I actually have a reason that I understand where my equity assets are going. So,
and that model's totally momentum based, or they're
No. Let me back up. It's fundamentally based, is what I told you.
Yes.
Listen, if you think the dollar is going up, more domestic. If you think inflation, taxes, and regulation are going up, you use smaller size, go to small cap. So it's all based on fundamentals, but it's also on price variable. And this is the difference between other models. See, you can look at the environment because everything we see is being traded. We don't use GDP. Because GDP, you don't know what's going to be until 6 months from now.
Yeah.
I know what interest rates are. I know where the dollar is today. And based on what I just told you, I tell you what my allocation is. And what Don was saying that is very important to make point. If you look at our allocation and what Don is invested on, you can tell what he believes and what he likes. Because we are right now, we're exposed to what? The large cap. And they say, okay, they like large cap. They think the dollar is going to be, like, you look at, there's a one-to-one mapping between our allocation and the variables that we use to describe the environment. So, I mean, if that doesn't match what you believe, you see who's wrong. Is the model wrong? Am I wrong? Or what's going on? And you can always check. And that's a very simple way to check your model and the consistency of your.
And then what if it doesn't jive with your belief? Do you change it? Do you override it?
No.
Okay.
Then you figure out what is it that you're missing,
and then maybe add to the model.
Like I'll give you one example. The last election.
Yeah, I was just going to bring up the election.
To bring that, I really believe that Mrs. Clinton was going to win, and I had a somewhat negative view of the market. And the model, in fact, we're saying that if you go back to the numbers, the market was sort of tanking before going into the election.
Yeah.
And the yields were going up and all that. So, the market's telling me she's going to win. So we were in position for a Mrs. Clinton victory. Then the election came out and I said, hey, this is a different world. We reran the model. And, we flipped from, I'm overstretching it, but there is from 75, I mean, in my long only, the money I manage long only, I had 75% fixed income. I went from 75% fixed income to 75% equities.
Wow. And so you mentioned regulation or possibility of more regulations. One of them, how do you get that input? Like, how does the market tell you that?
Well, it's very easy. Like what you see is, for example, like I'll give you an example right now with the coronavirus. Little guys are nimble.
Well-timed cough after coronavirus.
Yes. Little guys are nimble. They can take advantage of regulation and all that. In fact, what did the administration do when they tried to help the businesses? They say usually the regulation exempt all the little guys. For example, the small people, less than 50 employees, don't have to do this. Blah, 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 don't have to do this, don't have to do that. With the coronavirus, they gave all the financing and all that. What all the franchises do, or, like whether, like, what did they do? They didn't use a single corporation that would be too big. Each franchisee applied for all the small loans. See, you see what I'm trying to say? Small guys can always are more nimble. They can take advantage of the taxes and regulation, number one. Number two, like the tax collectors are elephant hunters. They don't go rabbit hunting. So if you need revenue, who are you going to go after?
Me.
Yes, not me, guys like you. So that's exactly my point. So
no, I mean, I'm a rabbit, not an elephant.
Oh, I thought you were. No, but you know what I'm saying? Like they go big taxes, regulation, and inflation. They usually tend to harm. They go after taxes, go after the big guys. The regulation go after the big guys because the enforcement costs it too much. The little guys can circumvent. So whenever you see taxes and regulation going up, guess what happens? Small caps tend to do better.
Right, but I'm just trying to get to what's that, how do you measure that taxes and regulation are going up? Like count the number of laws or
yes,
the relative performance?
I used to do a lot of research on that area. I'll tell you, it's a very simple measure. The number of pages in the Federal Register.
Okay, so if that's increasing, small caps. If it's decreasing, large cap.
The only time the small pages of the Federal Register really went down was, guess when?
Reagan.
You got it. Man to my heart, but that really
would have been my guess that it never goes down. It just goes up less, right?
Yes. No, that really, and you see it happening now with the coronavirus. What have we had? We have had an increase in regulations. Remember, because we have all the executive order, you cannot get thrown out of your house, you cannot do this, people have to do that, et cetera, et cetera, et cetera. Guess what's happened? Who's outperforming, the small cap or the large cap?
I thought large caps were based on the big $1 trillion companies, but
you'd be surprised that the small caps have outperformed the large cap by about 200 basis points.
For a year to date?
No, since the recovery, since March.
Okay.
Yep, just the last couple of months.
Yeah.
Oh, it's the big swing, upswing.
Yeah, and then you don't have any sort of value, right? Like Cliff Asmus is all crying all over Twitter lately if value's never coming back and dead. What do you think on that?
Everybody talks about that, but the question is that value is no longer value.
Yeah.
Remember, in the old days when I was, value was a very clear, precise definition. Now, anything can be value. And the other problem you have now with value and growth is you look at the sectors. I used to joke around. If you tell me what's happened to finance and energy, I can tell you what's happened to value.
All right. So values a lot of those energy players.
Yeah, and the financials.
And they got hammered by,
Yeah. And they're not doing all that well.
That all sounds good. So we mentioned Mrs. Clinton. I've never heard her mentioned so respectfully before, but well done. And then, so this election, it seems the odds are in Biden's favor right now. What are the models telling you? And will you do anything different this election than the one you mentioned?
Oh yeah, we're paying attention to a lot of stuff. Like the model, you have to be very careful with what people are saying and what the market's saying. Remember, the market's been doing fairly well.
Yeah, new all-time high.
But let's go back to our four variables. We had interest rate. The Fed has said that interest rate is going to be as low as far as they can see, and we don't see any inflation in sight. So, like for the pedestrian little guys like me, TLT might still be a good hedge because I don't see any danger on the big sharp rise in interest rate, a big spike in inflation. Fine. And that is the same for both candidates. It doesn't matter who wins, the Fed is going to keep interest rate low.
What do you use as your inflation gauge? Just CPI?
Yes, PCE. Personal consumption expenditures.
Yeah.
And
okay.
then,
so that was 2 interest rates.
Yeah, we more or less that. But we have what is very clear, very different than the candidates is their views on taxes and their views on regulations. And so if you think you're gonna have tax rates are gonna go up, regulations are gonna go up, I think that will favor small cap versus large, number one. But also the higher tax rate means what? I think that will be that the stock market is not gonna do as well. And I think not only that the stock market is not going to do well, the dollar is not going to do as well. So under that scenario, if you have to invest in the US, you increase exposure to small cap. But if you're going to invest in equity, you're going to increase exposure to internationals. And you're going to reduce your overall exposure to equities because you think the market is not going to do as well as bonds. That I'm not going to mention the candidate, but you can figure out which one I'm talking about.
Yeah. But let's talk bonds for a second. Where you think we'll go negative in the U.S.? We already have sort of. But what are your thoughts on bonds overall?
Oh, I think, like there's not a problem with the inflation rate. I don't see bond yields spiking up a lot. And you may see negative interest rate for the following reason. Everybody's missing one point. There is a look at the expansion of the balance sheet, and there is no inflation. Why? Because we have financial repression. So you have to have lived in Latin America to understand, or in the emerging market to understand what financial repression is like. Look at all the banks here; they're holding excess reserves. So by like 60% of the expansion of the balance sheet is being held by banks as excess reserves, and excess reserves are idle; they don't do anything.
Yeah, and then I've read that they aren't wanting to lend to the smaller names too. They're just going to lend to the biggest of the big.
Of course, because
that.
Nobody wants to make a mistake. You get fired if you make a mistake. You don't get fired if you don't do anything.
Right.
So,
which makes me think we're Japan all over again, right?
Well, in that situation. But remember, what they're doing is they're opening up for a window of opportunity for people like, how should I say, all those huge funds are lending money like Apollo.
Yeah.
All those people who are, are becoming non-bank banks, basically.
Yeah. And what are your thoughts on, so if, say you did have huge hyperinflation here, in theory, you'd see it in your asset prices, but you don't need or want like a gold or some sort of commodity trend inflation hedge?
No, I don't. I tell you why. Gold has done well, and don't get me wrong, and I would have lost money. I would have not spent that much money, but I don't see the inflation rate going up, number one. I don't see the economy booming in the sense like around the turn of the century when we had the commodity boom, the super cycle and all that, because I don't see the world economy growing that fast. So if you don't see that, what is the case for gold? The only case for gold has to be uncertainty and volatility. But, I joke around with people, say, you can't take it with you. Can you imagine you carry yourself, like what you have to do is, if you're going to do that, you might get into the cyber currency, and then hope that you don't have an Alzheimer's and forget your key number.
I'm in the Warren Buffett, although Buffett's been buying gold miners, right? But
yes, but remember, Buffett has had a bad decade.
Yes, yeah. But you're right, his line of if aliens saw us dig it out of the ground, put it back in the ground, put some guards around it, they'd be like, what are we doing?
Yeah, remember, when you're 90, you're not as good as when you were at 80.
Maybe 90's the new 80.
Yes, maybe.
Um,
I'm sorry.
and then I have one more point on when you're sizing and based on the volatility,
Yes.
right? There's been research on the flaws in volatility-based weighting. How do you counter that, right? Like in theory, you could have a big sizing on something that has a, Japan, for instance, they might have super low volatility, but they don't produce any return. How do you view all that?
But that's where the beta comes in.
Yeah.
And remember, the way we look at the world, and then I let Don answer some of this. The way we look at the world is a very simple issue. Think in an economic terms, you have to think in terms of reaction coefficient. Like the beta changes by economic policy. Let me give you one simple example of that. You've seen, I don't know, I don't know if how old you are. You look young enough, but I don't know if you remember that airline used to be regulated.
Yes. Yeah.
And when the airlines were regulated, they were high beta. Why? So it's a very simple answer. Because they had the landing rights and the gates were the limiting factor. Since the gates were fixed, during the good times, demand goes through the roof and you can't increase the supply. So what do? How do you ration the increase in demand? You charge a higher price and you make a lot of money.
Yeah.
And during the bad times, you get hammered. So the airlines were high beta. And if you remember back in the 1980s, you say, Jesus, Reagan gets elected. Airlines are regulated. The airlines are high beta. Oil prices are going down, interest rates are going down. That's the steal of the year because, the market is going to boom. And with the high beta, you were going to make a lot of money. Guess what happened? You would have gone bankrupt.
Yeah.
Why? Because two words, Alfred Kahn. I don't know if you remember who Alfred Kahn was.
No, I like the story already though.
He deregulated the airline industry.
Okay.
And then they became elastic.
And then
anybody who made money, if you made money on the airline, I started a new airline and charged $30 per seat. And guess what? They competed away and the beta went from 1.8 to 1.
Yeah, I think I've read the history of airline stocks. Nobody's ever made money.
Yes.
The combined stock prices are negative.
So, the airline, so the elasticity can change dramatically based on taxes and regulation, because the regulation can inhibit competition, prevent entry, and all those things, So, and that's why we have to pay attention to, the same thing with oil. When Reagan got elected, he did control oil, and he basically bankrupted. Look at what happened to OPEC. Remember, we had two oil crash. It went to $24 in '81, and it went to later on in the late '80s. It went to $10. I remember I wrote a piece in the Oil and Gas Journal in 1981 saying that the oil prices were going to go down to $20 a barrel and gasoline $1 a gallon. And a guy from Rowan and Company wrote me a letter, wrote a letter to the Oil and Gas Journal that how could they publish that kind of junk, that I was worthless, that I didn't know what I was talking about. And guess what happened 2 years later? Rowan and Company went under.
Yeah. I was going to ask how you remembered an article from 1981, but it's because that guy gave you shade. He said,
yes. You wrote the letter, and in that, but that's what happened. You remember those things. No, plus it was a very good forecast. You get lucky twice.
What was the other one?
Later on, 5 years later, I predicted the $10 a barrel gas. And then I gave a lecture I made a presentation in Denver Petroleum Club, and they went after me because I don't know anything about oil. I'm an economist. I just know about economics. And they started going after me. So all I can tell you is that I got lucky twice.
There you go.
Yes.
And Don and Jim, let me bring it back to you quickly. And just so, how do you view the rebalancing premium in all of this? That's right. Like, is it active? Is it at month end? So if the convexity pops in, is that immediately going into the beta component?
It depends. I mean, we look at a few different things. I mean, it's not necessarily immediately going in. We need to measure that versus the additional cost that it would to mitigate that risk as well. So, there's, again, we'll look at our model to help us decide that. But, like you said, at the very bottom in March, sure. I mean, the cost of added protection is pretty high, and we need to weigh like the rebalancing and reinvesting against that. I mean, we were able to do it relatively quickly, which is what you want when you were talking about compounding over long periods.
Yeah, and from other products I'm involved with and whatnot, it's always right. It's not just the rebouncing, but the ability to stay in the beta. That's probably even.
And we stay in the beta. That's the idea.
That's the one thing I will say that we are definitely not market timers. We always want to be in the market, and when people talk about risk mitigation, it's hard for people to actually bite the bullet and get out of all their positions. And if you miss 1 or 2 days, I mean, that we've had a couple 5-6% days. The thing that on the risk side, one of the things Victor talks about with interest rates are going to be low to or someone describes it return-free risk for the next 10 years. It kind of means that $1 today is going to be the same as $1 in 10 years. It lengthens everyone's horizon, which is going to lead to I think increased volatility. So are we nervous, could there be a disruption or a shock? Obviously with the election, because there's some very stark fiscal and tax regulatory differences in the two parties, and you're seeing a lot of people. I think everyone's pretty nervous, and sometimes I think I'm not nervous enough, but I see just increasing volatility because people have gone to a lot of cash. I think there's a lot of reset on where do I want to live? What do I want to invest in? And I think most people have gone to that. All right, I'm going to go to cash, and I think all that movement to what I would call short-termism now is what's kind of driving the volatility that we're seeing here.
Right.
Except to the Robin Hooders that are saving the market.
Yeah, I don't know how much I buy that narrative, but and the whole problem with going to cash is when do you go back in, right?
Yeah.
You're never going to
feel. Timing is not a strategy. That's just a recipe for.
It's not a strategy.
Most likely, you're going to miss out on the return. So it's not a way to manage your risk or manage your portfolio.
All right, guys, I think that's good. We're going to move on to our favorites section, close out, learn a little bit more about you guys. So Victor, one of your passions is Paso Fino horses. Did I say that correctly?
Yes.
What's a Paso Fino?
They're gated horses. They're like Tennessee Walkers. They work on a 4-beat lateral beat, and they come from the Berber horse during the conquistador, the desert. Like traditional horses are diagonal, and when they walk, and the center of gravity goes up and down. Okay. So if you look at a lance, if you're a lancer, if you're going an English horse or a quarter horse, the lance will move sideways, and you might miss your opponent. But the Berbers were lancers, and the horses were like pacers. And when you're on a pacer, the lance goes up and down, but never sideways.
Okay. So can I bet on them at Saratoga or something, or no?
No. But the advantage of the pacers is that they're very comfy because the center of gravity doesn't switch, and when you glide laterally, and that's why they're called plantation horses. So all the plantation owners like to ride in a comfy horse to go around their property when they look at what their work, and that's how they develop. And then,
so you own a few of these?
I own a few of them. And I own a little ranch in Dominican Republic.
Perfect. What's your favorite one? Do they have names?
I love them all. You got to pick one. We have a big ranch, and we've been in the sugarcane business for over 120 years now, my family.
Wow. I always have a question. If you crush up the sugar cane, what do you get? Brown sugar? And then
No,
they
you get the syrup.
the syrup.
Yeah, you get a syrup it's like a white washy syrup that's very sweet, and that's what they make the sugar from. You cross the sugar cane, you get the syrup, and then they cook it, and
Okay.
and then you break it down into molasses. Is the residual,
Yeah.
the leftover, and the other part, you keep growing until and a centrifugal force, to get rid of separate the sugar from the liquid, and it crystallizes.
Okay. And you're offering a free stay at your Dominican ranch for anyone listening to the podcast, right?
Oh, absolutely. and I will make them, like the antediluvian days, I'll make them milk the cows and cut the sugar cane for me.
Perfect. I've actually cut sugar cane before. I grew up in Florida, and I can't remember why, but we were out there in the Everglades.
Oh, by Oquilanda? The Oquilanda?
I can't remember exactly.
There's
But
a sugar mill that is owned by the Franjuls.
ah,
And they also own Casa de Campo, if you are into high-end places in the Caribbean.
okay. I don't know that one, but I am into.
That's a good one.
Well, the check Casa de Campo is the most complete resort in the Caribbean.
All right, we'll check it out.
Fly in your own plane if you want.
Oh, all right.
And he has 2 Pete Dye golf courses. An amazing marine. I met Pete Dye there at the party, at one.
Wow.
And then I'll tell you a story. I'm sorry about that.
No, go for it.
I'm talking to him, chatting with Pete Dye and all that. And he said to me, and then I started talking about, and he said, "Where do you live?" He said, "Well, I live in Rancho Santa Fe." And I said, "Oh, me too." At that time, we were living in Rancho Santa Fe. And
Wow.
he did the farms in Rancho Santa Fe.
While we're on golf, Jim, favorite Chicago golf course?
Well, I'm partial to Exmoor, which is my home course, but I do love Shore Acres is probably one of the prettiest in Chicago golf. I mean, we're spoiled for choice here, and I'm just happy to see. It's great to see at least a live sport, even without spectators. I don't miss Baba Booey after every tee shot, to be honest. So.
Oh, by the way, we have the Teeth of the Dog, if you ever heard of it.
Oh yeah.
Teeth of the Dog. I don't know that.
That's a vicious course, Pete Dye.
Okay.
It's a top, it's a hole in the ocean. It's really cool. We have
Don, you golf?
I'm probably about 8 or 10 times a year. We have the Village Links out here where I live. It's a fantastic public course, and you get a
Glen
discount.
Ellen, yeah, I've played there
It's like the value play if you live out here. It's nice.
this year. And what your favorite college football team, Don?
Well, it's got to be Purdue University.
All right, you're a Boilermaker?
I'm a Boilermaker through and through.
I'm a Hoosier,
Uh-oh,
Trojans.
tension there.
Trojans.
Yeah, we didn't know that.
But we're just being bitter rivals here, but
Yeah.
And Victor, favorite cocktail to drink while reading Cocktail Economics?
Oh, I like sangria.
Sangria, okay. Not
Yeah.
some Dominican rum made from the sugar?
No, because sangria makes you nice and pleasant, like in the afternoon.
And that's your book, correct? I haven't read it, but Cocktail
Yes,
Economics?
Economics.
Why?
And I got a more recent one that is a little bit more academic.
All right, we'll put links to all the books in the show notes.
Oh, you don't want that. It goes.
And then we ask all our guests' favorite Star Wars character. I'll start with you, Jim.
Han Solo.
Han Solo. Okay, no repeats.
Oh, that was going to be mine. Well, I guess I got to go with Luke Skywalker then. He's
All
pretty
right.
good.
Victor?
Darth Vader.
Darth Vader. Can you do a Darth Vader voice?
No, but he was a good guy.
That sounded like it.
Yeah, he was a good guy in the end, right? He
Yes.
redeemed himself,
Yes.
like economics.
Yes.
All right, guys, this has been fun. Thanks for coming on. And we'll talk to y'all soon, hopefully in
Great.
person.
All right.
Thanks, Jeff.
Thank you.
You've been listening to The Derivative. derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.